Good afternoon, ladies and gentlemen. Thank you for taking the time out of your busy schedules to join our webinar today as we discuss financial planning for those in Netherlands and Germany as U.S. expats. The presentation will begin shortly. I will be the moderator of the webinar alongside our panelists of guest speakers who I'll be introducing shortly. We'll be putting everyone on mute if they're not already, so please feel free to ask any questions in the chat. We'll do our best to answer them for you or interrupt the speakers to get their thoughts on the matter. Just before we begin, a few disclaimers to go through for compliance, so just bear with me for a moment. The information presented here is for educational purposes only, so it does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. So be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. So yeah, today we want to talk about financial planning issues, like I said. And so with us, we have a couple of speakers here today. So our first speaker is David Bellingham. He's the CEO and director of Black Swan Capital. He's been advising international clients and heading up financial services businesses for over 20 years on 3 different continents since he started working as a financial advisor in the 1990s. With us also is Brian Dunhill, financial planner with a core emphasis on concentrated positions and retirement planning for expatriates. He's also the director of Dunhill Financial. So with that, what I'd like to do is just kick things off with just kind of a flexible, get it the right way around, fireside chat. Well, first off, I don't know, I guess I'll offer up a softball to begin with. What are some key issues that you might face as a U.S. expat while you live abroad in the Netherlands or Germany? Could be well, I guess is a broad question anyway, but where would we take that?
I told David that I would take the easy questions and then I'd give him the hard ones. So I'll put up the first big challenge for any Americans that live outside of America is finding institutions to bank or invest with. Germany and the Netherlands are not on the hardest list, but a lot of your traditional brokers back in America, your Wells Fargos, your Schwabs and Pershings and such, will ask you to leave the minute that you move abroad. So essentially, you need to find an institution to work with that will allow you to hold the account while you're living in the Netherlands or Germany or any other European country from that vantage point. Just because the local banks won't let you invest with them doesn't mean that you should invest with them. That's probably the biggest favor that they could ever do for you. And we'll touch on that later on when it comes to the taxes. But basically, you don't want to fight too much to be with an institution that doesn't want to have you as a client, because it probably means they don't know how to address the issues that David's going to talk about in a little bit.
Yeah. Thanks for that. It is complicated. Finding an institution that will take you is hard, and so in that broader sense, we call it being compliant. You can somehow find yourself in an investment that will take you, but if it's not compliant, and we'll go into that later, it may be worse than being in nothing. So that is a big issue, and I think at the broader financial planning level, one of the more difficult things is staying aligned to your goals, objectives, and your strategy. And this happens for internationals or expats from many countries, but notably from the US, because of that complication of the institutions that are more reluctant to take you, that people feel like they need to abandon their strategy sometimes, or their goals, or put it on hold. And one of the key messages we're often conveying is that you don't need to do that. You can still stick to those longer term plans. In fact, it's often the case that you need to reassess those and get an update in the sense of what you're trying to achieve, but sticking to those goals, having a plan that you can operate when you're living in the Netherlands or Germany is just as important as when you're living back home or where you go to next.
Yeah, brilliant. Okay. Now, in terms of, so the expats And one of the key aspects that they would face would have to be maybe the currency. Maybe they're banking in the US, or they have some USD, some assets in America and the States and everything. Of course, there could be a bit of a currency risk there when it comes to living in euros, or as well as any other currency. Are there any particular ways that are better to manage that, or just what's a good general strategy for that if you're ultimately buying your bread in euros, so to speak?
Can I give my favorite answer here and say it depends?
The
the least
economist
satisfying,
answer.
but the most accurate response. It depends on the person, and you're right that it does make sense to earn and spend in the same currency. That's a basic fundamental, but you need to look beyond today and also look at what your plans are. Are you here in Europe for 6 months and then heading back to the US? Are you of the mindset that you'll never go back there again? Where are most of your assets that you're allowed to continue to hold? So there's a number of issues at play. But I think overriding that, and I think, Brian, you'll probably get into this a bit, is about being in a jurisdiction or a currency doesn't necessitate holding investments in the same currency necessarily.
100%. I think the best example of that is Switzerland. We would never imagine trying to build a Swiss-based portfolio where there's huge companies based in Switzerland, but most of their revenues are not actually in Switzerland. So are you really naturally hedging to this Swiss franc?
Right.
Now, where the difference comes into place is when you have more and more fixed income inside of the portfolio. So when we're in a growth trajectory with the stock side of the portfolio, we can naturally hedge portions by owning certain companies that might have more revenues or the such. We happen to have gone through 14 years where a dollar-centric portfolio would have outperformed a little bit, but longer term, i.e. in a retirement trajectory, that actual limitation or the lowering of the risk of the currency will help us. As fixed income levels, which are historically low, i.e. negative in Europe, and increasing on the US front, which is what's pushed up the dollar in the kind of last few months for certain, once we get to more normalized rates, what we'd be looking at is more of a need to have a natural hedge on our currency. And that's what we do with our different portfolios. You know, we have a US dollar line, a euro line, a GBP line, and we also have an Australian line, just for your children, David, just in case they stick around over there in Australia. And the means of each one, they will all have a significant amount of US investments, European investments, etc. But they'll have more in the currency that you'll be needing the funds from, which reduces some of the risk of needing to take out at that wrong moment. Because what we've historically seen is that we have 10 to 15 years of dollar strength, then 10 to 15 years of weakness, i.e. we typically just have an up and down segment of returns from that vantage point. We've gone 14 years with dollar strength. That doesn't mean we're calling a top. It just means that we're expensive on the dollar. So when it reverses, it can reverse for a longer period of time.
All right. Speaking about currency risk, I wanted to switch gears for a second because there is something else to address here about, so not just the risk, but in terms of the financial planning that we have, we also want to look at the kind of assets that we want to keep. So in addition to whether to keep them in the States or in Europe. This was, I think, more of a question for you, David. So that in terms of how can we address asset allocation and dynamic portfolio management, either maybe when the markets are volatile or if the market's going through some particular cycles?
Yeah, that's a really good question. It's something we're spending a lot of time talking with clients about. And it's something you need to be careful of, that in one sense, you need to be absolutely cognizant of what's going on in the markets, what's happening in terms of market cycles. But in a contraposition, you don't want to be reactive, because we firmly believe we don't know what's going to happen tomorrow. We won't sit down and tell any client what's going to happen tomorrow. We will be able to set out a path and tell them what they should do for the next 5, 10, or 20 years. And that's really, I guess, the response to your question. So it's to counter with the question you're trying to achieve. What are your objectives? and then aligning to those end goals. And the short-term movements are inevitable. If a market's going up or a stock's going up, it will go down at some point. If it's going down, it will come up again. Markets go up and down, but they go up over time, but not in a straight line. So if we can remember all that, and it's really easy to say in a forum like this, if you're looking at your own account, your own investment, and watching it go through that volatility, it can be hard to take, and we realize that. But and so it's important just to take a step back and say, where am I going? What am I trying to achieve here? What's the long-term objective? And is my portfolio still aligned to the objectives? Are the fundamentals still good? Yes or no? Are we adapting to core cyclical changes in the market? Yes or no? And then if those questions are answered in the affirmative, then there isn't too much you need to do. We can leave it to the discretionary portfolio managers who manage the details of buying and selling particular assets. So we're really focused on the strategy and the alignment at that level, not about, do we think stock X is going to go up tomorrow or down the next day?
That's 100%. And for a panel of four gentlemen, or three gentlemen and myself,
I thought you were going to go with me on that. That was a nice switcheroo. It's a bait and switch.
I liked one statistic that we were looking at for one of our advisors is giving a women's conference in a little while, and what she was looking at was that women typically outperform men's portfolios because they act in more of a systematic way going forward. In other words, they don't try to trade the markets when it's up or down, and they don't react to the markets. They go with that consistent plan that we set out. Now, inside of our portfolios, we always do what we call a core plus satellite approach, which means 80% of the portfolio at minimum has to be in our core positions, exactly what David is talking about. Positions that are going to be long-term. We could close our eyes and know that they're going to be there and solid a decade from now, with no major fluctuations in that regard. The other 20% were allowed in satellites, and those satellites are really built to be hedges. They're not supposed to be speculation. They're supposed to be avoiding certain risks. And to me, risk avoidance is the best way to get those good, solid long-term returns. If we know that we're on a 15-year trajectory of dollar strength, well, we're going to have an over-allocation to the dollar. We're not just going to say, let's just own that. When we know that fixed income rates are actually increasing, just because a strategic allocation would say we should have a certain percentage of 30-year bonds, I think David would agree with me when I say I don't own any 30-year bonds inside of our portfolio exactly. Just because my college textbook said I should own some. So we want to avoid risks more than trying to predict the market and call those things out.
It's a nice consistency. We often say to our clients, we look at their objectives and say, what's the lowest risk pathway to get you to your objectives?
Absolutely.
Mm-hmm.
Right. Actually, yeah, it's kind of coming onto the thread of risk. I want to also bring up something we've spoken about at length for a while now for reasons that will be obvious, but don't want to belabor the point too much if we've beaten it to death already. But in terms of the tax implications, what are the implications if you want to keep your assets in the US or if in either the Netherlands or Germany? Are there any particular issues to be aware of on that side of things?
Before David jumps into this, let's break it up into a few different functions, if you don't mind.
Oh, I don't mind.
Why don't we start with the conversation on investments held in Europe, specifically outside of pensions? So what would be considered passive foreign investment companies. Do we want to touch on those just a little bit?
Yeah, let's preface all of this by saying I'm not tax advisors. I'm not a tax advisor. We obviously take tax into consideration and we guide people in this context. But as soon as we get to that point of demarcation, we're very clearly directing someone to a specialist tax advisor, which they should do.
100%.
So that's the preface and the I guess the positioning. So yeah, absolutely. So PFICs or passive foreign investment companies are really important for Americans because I think, as I mentioned a few minutes earlier, you can theoretically invest in just about anything. It's not against the law. It's just so prohibitively taxed that it may as well be that that you can find yourself in a vehicle that your colleague from another nationality may be invested in compliantly whilst residing in Europe, and you are not compliant in it because of the US definitions of this investment being a PFIC by default. So that can mean that you're taxed at a much higher rate when you're doing your US tax returns, and that can erode pretty much most of the gains that you can certainly stifle your financial plan. Do you want to add to that, Brian?
No, I think that hits all of those major aspects of it. To me, it's cost prohibitive in two ways. One is the tax. Second is the preparation of the tax. And on top of that, most of your tax accountants don't actually appreciate the extra costs that they're able to charge for doing those PFIC filings. So if you don't believe us, which you shouldn't, because like David said, we're not tax advisors. Before you ever invest in a PFIC, call your tax advisor and say, what do you think about me owning this European security? And they'll tell you how much they're going to charge to do the tax filing for it on the US side every year. And that's before even the taxes are owed, which is extremely hard to calculate and extremely annoying to calculate. So that makes it much easier to actually make our investments on the US side of things. Which now let's divide it up into Germany and then the Netherlands. From the Dutch perspective, find it a little bit easier because we have a wealth tax over there in the Netherlands.
Right. And there's two tiers of that, and the same preamble applies. There's two tiers to this, I guess. And the thing that a lot of expats talk about, particularly if they're newer to the Netherlands, is the 30% ruling. This is what everyone aspires to achieve as they get here. The 30% ruling is done to incentivize and to bring highly skilled internationals into the Dutch labour market. It has one advantage, which is you get a 30% reduction off the top, so you're taxed on 70% of your income. That's great in a high tax environment. But we think just as important for people with a large amount of assets is that you usually don't have to submit a wealth tax declaration for as long as you're on the 30% ruling. That's 5 years. So no wealth tax. So with a few particular anomalies about being a substantial shareholder accepted, there's no capital gains tax in the Netherlands. There is a wealth tax, which you might call an unrealized capital gain. 1st of January each year, you calculate how much assets you have worldwide. There's a minimum threshold, which is 50,000 this year for an individual, 100,000 for a couple. That is tax-free, and above that, there is a presumed rate of return on which you are taxed. So net, it comes out at a fairly low tax rate. We're saying that's the only low tax in the Netherlands, really, but it comes at a relatively low rate. It's quite simple to apply. There's a watch over it at the moment because we know that at the EU level, they've challenged the Dutch government, saying it's unlawful to calculate it the way it is, and there's been a lot of money now about to be paid back to people that was charged as wealth tax over the last few years, which means they'll probably do it on actual returns as opposed to presumed rates of return going forward. It will still exist in one form or another, but that does make it a bit simpler compared to Germany, where they have a capital gains tax environment.
Now, with both of this capital gains tax in Germany and the wealth tax in the Netherlands, we still end up having to pay or report our tax in the United States.
Right. But
we're able to use those credits against that in the United States. So it's not really a double dipping or a double taxation. It's just a double reporting requirement,
right.
Which is the good news. So we get to keep things as easy as possible. So I think to summarize, we'd say, okay, outside of pensions, we want to keep our investments on the US side because it will make the US side easier, but we'll just have to do a double reporting. When it comes to pensions, essentially that can get much more complicated in certain factors. And sometimes the corporations can be, well, if they're giving you a matching or a pension of some sort, you're going to avoid PFIC rules. Some accountants will want to apply it, but most don't. But essentially, It's more the distribution policies when taking money out, which can be painful at times. So you want to be cognizant of that, and you want to talk with your financial advisor about how much and how painful that might be, depending on where you're going to end up. Because, for instance, an IRA is not necessarily the best vehicle if you're going to retire in Germany. The Germans are very punitive on individual retirement accounts or 401ks. So you might want to take a year vacation outside of Germany. If you're going to make a big IRA distribution, the actual tax saving might actually pay for the vacation.
But at the same time, if you're looking at Dutch or German pensions, you need to look at when do I want to retire and where do I want to retire, because they may kick in and actually have that access to income much later than you otherwise anticipated, and quite different from your US pensions.
Would this be about the IRA or like a different account, you mean, or just
a Dutch or a German pension? So you might be, there is a three pillar system here. So the first pillar is the state, isn't means tested generally, so everyone's accruing towards that on an annual basis. Second pillar is the employer pension. The third, if you have a personal one, but yeah, they have a deferring access that's getting later and later, and they're all working towards age 70 eventually. So if you want to stop working before age 70 and your pension is locked up in one of these systems, you need a supplemental form of income.
All right. Did you have anything to add to that, Brian?
Absolutely. Well, just one thing to add that's really nice about the state pension, because that three-pillar system is the exact same system that we have in the States. Now, essentially, we also have a totalization agreement between both the Netherlands and the United States and Germany and the United States. There's, I think, over 70 totalization agreements at this point in time that the United States holds. And what this means is that if you don't have enough credits in the United States, but you worked part of your career in the Netherlands or Germany, you can still get a US pension, even though you don't have your 40 credits. This can be really helpful, especially if you've moved around Europe or to other places, because you'll get different pieces of pensions, which will equate to somewhat of a real government pension. In that form, you're just going to have to contact the Social Security Administration to tell them, because they're not going to know that you were working in the Netherlands. They have to be told. So it's always good to keep good records, maybe keep it on your balance sheet, keep it with your financial advisor, keep good records of where your time was spent and where those pensions are, because when it comes to those corporate pensions, I don't know about you, David, but some of the companies that I've come across, they've been acquired 4, 5, 6 times by the time the client gets to retirement, and finding out where the money is it's not like easy.
Absolutely, you're chasing all sorts of dead ends.
All right, brilliant. Okay, well, thanks for all those clarifications. Another question I have, this is kind of a completely different one. Actually, if I could cheat a bit, because there's a question in the chat related to what we spoke about a bit ago, we have a question about what is the situation if I'm living in Ireland from an Irish tax position and have assets still in the US? Any thoughts on that one?
Oh, sorry, David, were you gonna?
I was letting you go ahead there because it sounds like it's one for you, but I'll jump in after you.
Well, the joy of it, it's very similar to Germany in that regard, that essentially the Irish will be able to tax it first. You'll report it in the US, and any subsequent tax you'll pay in the US. But mostly likely all of the tax will be owed in Ireland if the assets are over there in the US. The only contrast is on retirement assets, where you might have a withholding tax by your institution. So when you take the money out, they charge the tax, a part of the tax right away. And therefore, if you owe more money in Ireland, then basically you'd be able to claim that back based on the tax that you have to pay in Ireland. But most countries' double taxation agreement is that you pay the tax in the country in which you reside first, and the remaining in the other country. Where it gets complicated on the addendums is countries like the Netherlands, and that's why we love talking to David and having an expert on the ground there, because essentially wealth taxes and the likes are a little bit different and fall under the addendums. So you want to make sure you work with an accountant that knows the Netherlands. Otherwise, you'll end up paying 2 sets of taxes and not being able to take advantage of those credits.
So David, do you have any thoughts on that? Or do you think
But
it's
I
been...
think it's been pretty thoroughly answered, really. Yes.
Okay, brilliant. Okay, another thing that might be worth discussing here is that when we talk about financial planning, a big part of people's financial planning is sometimes house purchases, real estate, that sort of thing. So when you're living abroad, whether Netherlands, Germany, or somewhere else, are there some particular considerations or things to be aware of if that is somewhere in your short, medium, or long-term financial plan?
It's something we talk about a lot to clients, and it is somewhat market specific. In Germany, different regions have different acquisition costs and tax regimes. Netherlands is a bit more straightforward. The Dutch have rather low barriers to entry for property, and that makes it, has made it the last couple of years rather attractive. They've tightened up a bit, and you can now only borrow 100% of the purchase price. So going back a few years, it was 105 or thereabouts, so you could cover your costs and maybe put a new kitchen in as well and not spend a cent. So the question would be, why wouldn't you? So even now at 100% of the purchase price, you're covering your own cost at a mortgage rate of sub 2%. A lot of expats were saying, why wouldn't we, even in an escalating market? So it comes back to strategy again, the reminder that contrary to what a lot of people think, the property market, like many other markets, can go up and down. And we have clients that have lost money in the Dutch residential property market. They've bought at a point in time where it was high, and several years later, they're still below that mark. Now, it's not mark to mark, so unless you're wanting to sell it, it's not usually an issue. But it is a stress they carry that it needs to get above that point before they sell it, so that they've at least covered their mortgage and that they're not, in negative equity realized when they sell the property. If you look at the differential between mortgage interest rates and rental yields, there's still an advantage potentially in buying a place if you're going to be there for the long term. But again, we would look at their core strategies, and say, are you buying it on matching your cash flow? That is, how much am I paying in rent in actual amounts versus how much am I going to pay for mortgage? Will I be able to afford a property for that equivalent cash value? And will I be here long enough? Because if you're going to be here for 3-5 years, it might not be long enough. That might be too great a risk to bear in terms of the potential for a market to go down again. We remind clients that the UBS Global Property Bubble Index has had Amsterdam, for example, in the top 7 cities in the world for the last 3 years running. It doesn't mean it's going to burst. It means it is, by their metrics, at higher risk. So all other things are being equal. So I think it's a good idea to consider it if you're in a market for a long time. You need to think about the complexities of Germany, because whilst in the Netherlands you get tax deductions potentially on the interest component of your mortgage, sounds quite attractive, although that's scaling back a bit over the next couple of years. In Germany, there's still capital gains tax on your primary place of residence unless you've held the property for 10 years. That's a government's way of disincentivizing property trading, I think. But at the same time, if you're not going to be there for 10 years and you hold it to take that tax advantage, again, we've seen with many clients the complexities of trying to manage real estate portfolios from afar and in a different language. So you need to weigh up those issues as well.
Yeah, I thought, David, that we agreed that I was going to be the good cop and you were going to be the bad cop for all of these different conversations.
Wasn't that good cop?
Oh, so that, to me, everything you said is spot on, and I'm going to cover 2 other aspects because, first of all, the IRS ends up sometimes being the bad guy. This is where we've got you covered. David can help you find good solutions to help you set up all your investments on the German side, on the Dutch side, in America, so that it's conforming with all the rules and it doesn't punish you in any way, shape, or form, because he'll utilize the DTAs, the double taxation agreements, to be able to avoid all that duplication of tax. It's just duplication of reporting. On the real estate side, this is where it nicks you. And that's where David hit it right on the head. Speculation, short-term real estate investment could be at your detriment when you're an American expat, because the IRS is basically going to say, we don't care that it's in a different jurisdiction. We still want to potentially tax it, right? Now, sometimes this is no big deal because, well, let's just say you're a married couple and it's your primary residence. That means you still get $250,000 a piece, so $500,000 worth of capital gains. And if you have a couple years turnover on a property and you make over $500,000, I'll commiserate with you, but then I'll remind you that you made over $500,000, and that's a heck of a lot of money to make over a couple of years. So we still get that exemption, but it's those long-term investments, and it's especially painful in certain situations because naturally the IRS only considers things in US dollars. So therefore, if you buy a property in euros, 10 years later, let's say the euro appreciates. I know this is a thing that we haven't gone through for 14 years, but it does happen for long periods of time. If the euro appreciates and the property stays at the same value or even goes down, you could owe a phantom gain to the United States government because you actually made a capital gain in dollar terms. They only consider it in US dollars. On top of that, they don't let you offset the loss on the mortgage. So this becomes something that's very important for your financial plan and something to consider before selling the property, because once you sell the property, the decision's been made. So sometimes you might be in a position that you've owned a property, the currency went in the wrong direction for you, you have a phantom gain, and therefore it might be better to rent the property for a period of time rather than selling it right at that given moment, that you might have big capital gains for the year. So very important to know about those phantom gains. It shouldn't prevent you from having your family house, because like I said, it's $500,000 for your primary residence that you have tax-free on the US side, but you need to be aware of it from the financial planning vantage point. The other thing that I would state is that, well, for some of us, essentially, we've only seen rates go in one direction. It was 1982 that interest rates topped out. And ever since, for the last 4 decades, we've seen rates going lower and lower and lower and lower. And finally, here in January of this year, we've seen rates start to move up from 1.5% to closing in on 3%, hopefully not, but closing in on 3%. I'm quoting the 10-year bond rate for that, which a lot of things work against that. Now, essentially, if we go into a rising rate environment, it's the opposite of a falling rate environment. If interest rates go down, all of a sudden, for most house buyers, they're able to afford more of a house, right? So that's basically like sailing with the wind behind you. David, you live in the Netherlands, so you got to be a sailor, right? It's easy to sail with the wind behind you, but essentially it's not impossible to sail upwind, but it took the Dutch 400 years to figure out how to sail upwind from Cape Town up to India. I think only half of that time was probably because they just really enjoyed spending a couple of months in Cape Town while the winds turned. But sailing against the wind is a little bit harder. And that is exactly what's happening when interest rates start moving up over the long haul. So if we continue to see inflation, and if interest rates continue to rise because of that, it's going to be more expensive to meet those mortgage payments, making it harder for the real estate market to do what it's been doing for the last 4 decades. That's not necessarily what I'm calling and predicting, because if anybody's tuned into our economic updates, basically we're saying there's 4 forces that are moving inflation, and 3 of them are transitory. The 4th one is the unknown of the Russia-Ukrainian war. We nearly made it through an entire presentation without bringing that up. Nearly, we came close. So essentially, we've got an unknown and 3 transitory effects. So hopefully this inflation is controllable. But the key word there is hopefully. If the Fed has to increase those rates, that will hurt real estate prices because mortgage rates will be more expensive. I think this is when Josh throws me off the call for being morbid and sad.
Well, I will I'll not kick you off, but I'll actually kind of keep it on that same topic, because if we're talking about what we expect in the future, I guess another aspect of that is not just what to expect from the economy, but from any potential regulation changes. I don't know if there's anything on the horizon that we expect there, but is there anything in the either the political or legal arena that we should be aware of going forward?
There's changes to the Box 3 wealth tax being addressed here at the moment. That's, as I mentioned before, the European Union had an issue with the Dutch government in the way they do projected returns as opposed to actual returns. The details of that was that the people may have had large amounts of money in the bank, earning approximately zero, maybe a little less, but being presumed to have made 2, 3, or 4% and paying tax on that. That's why that's been challenged. The Dutch government is now paying a whole lot of money back to people, and will work out a new way of taxing it back off of them again next year. So there will be changes in that.
And for those unfamiliar, could you go into a bit about Box 3, what that is?
Okay, yeah, I should do that. But when you fill in a Dutch tax return, there are 3 boxes, 1, 2, and 3. Most people are concerned with 1 and 3. 1 is your income tax, and 3 is your assets. That's the wealth tax, and that's where you do the wealth tax and declare your assets, and that was the calculation they would use to determine the tax payable. And that was the link that I mentioned before, back to the 30% ruling that some internationals are fortunate to have, which means they typically don't have to complete that section for the duration they have the 30% ruling.
All right, brilliant. So Brian, did you have anything to add to that?
Well, I'd love to say that the Residency-Based Taxation Coalition is going to make a big stride towards RBT going forward. The God's honest truth is the American government is doing what they do best, which is hardly anything. They can't get any traction on these Biden changes or anything else. There have been rumors that we'd see a reduction in estate taxes. Most likely, we'll get to the sunset clause in 2025, and then Congress might move towards an increase instead of a decrease of that. But the sunset clause, I think, should bring it down to 5 million. Bernie Sanders' proposal is to try to bring it down to 3.5 million. If you're looking at making big gifts on the US side, well, it might be worthwhile to do it prior to any of those actions happening. In the past, we've seen that there's a grandfathering in of those types of gifts if you were making them over those exemption limits. So make sure you talk to your advisor if you're thinking about making gifts or you might have an estate tax situation well before that. It's very important to talk with a cross-border advisor of how it works, say, in the Netherlands versus the United States, or Germany versus the United States, from those vantage points. But essentially, at this point in time, we've seen a Biden administration that can't seem to be pushing too hard on that front.
All right, brilliant. All right, well, what I'll do now is we'll just open it up to any Q&A that you have in the chat. So if anyone has a question they'd like to ask, feel free to put it in the chat, and we'll happily address that. One of these is we talked about a bubble risk. I believe that was in regards to the Netherlands. So I guess that's for you, David. Was there any information about where that more on that could be found?
I was talking about that in the context of real estate, and it's really a global view. UBS puts a report out every September on residential real estate markets around the world, and markets they consider at greater or lesser relative risk of a bubble, that is a imminent collapse in the price. You can access that through UBS, and if you can't find it, you can always contact me, and I'm sure we've got a copy of it here. We've got the last 2 or 3 years of it on file. And as I mentioned, that Amsterdam was in that top 7 over the last few years. Munich's been up there as well from the German side, which is interesting and continues to be so. It's not the only factor to consider, and it depends on your time frame and a whole bunch of other factors, but it's worth looking at.
Okay, let's see. Again, feel free to ask your questions if you have any there, but was there anything else today that we wanted to get to that has not been discussed? Anything that you guys think is well worth mentioning that I haven't covered up to this point? Or have I done an exceedingly good job? Is that what you're trying to tell me?
I'll let you go first, David.
I was just staying silent to let him bathe in the glory for a little bit longer. But look, I feel like we've covered a lot of it. I think when I reflect on client discussions that we have every day, people often want to ask about volatility and the external factors that are impacting their finances. And I think we addressed that right at the beginning, talking about the fact there is always a short-term factor impacting markets, some positive and some negative, but the long-term focus on your goals and objectives is more important. I think we've addressed that. We only mentioned the war once by name, and you did that
twice now.
Just a minute ago. Twice now, I know. And I think that's an example of these external factors. I just want to link that back.
David, you've been officially banned from Russia forever for calling it a war. But,
Well,
you know,
I'll get my little badge of honor soon then, Sean.
Exactly. Josh, first of all, I think you've done a fantastic job. And David, I think you nailed it right on the head that the planning, the end goal is where you really need to start. If all of a sudden you think with the end in mind, all of a sudden you want to put all those pieces together to make sure that you avoid any of those problem areas between the pensions, which can be problematic at different times. It becomes the question of whether you want to fund them or whether you don't want to fund them or how much you should be funding them. Then going into the compliance on the US side and the local European side and making sure that you use the right pieces and then touching the currencies. So if we think with the end in mind, and then we make sure to avoid those different risks along the way to minimize those, well, we'll be able to get to that beautiful scenery behind you. That looks like a nice retirement spot, David.
It does. Unfortunately, it's not like this every day, but the days it is, we capture it.
A couple of questions now in the Q&A section. When living in Belgium as a U.S. person, so it's probably a question for Brian, is it better to invest in Belgium or in the U.S.?
So whenever it comes to outside of the U.S., naturally it's a loaded question, but for the most part, the investments are going to be better to be in U.S. vehicles because you avoid all those PFIC problems. Now, Belgium is a little bit nicer than the Netherlands and Germany when it comes to taxation because they don't have a capital gains tax, first of all, and they're very nice on retirement accounts like Roth IRAs, traditional IRAs, and the likes. So Belgium becomes a very easy place, but I would still keep the investments for the most part in the US. I'd love to see that UBS report on real estate in Belgium because I think the last time that I look at the Economist report, David, just because I try to get every single nickel I can out of that heavy subscription fee that they charge me. I think Sweden is the most expensive to earnings and Belgium is number 2.
That doesn't sound surprising at all. Yeah.
But still, Amsterdam seems like a wonderful place to be.
The worst places.
Another question about Belgium, actually. What are the tax implications in Belgium for transferring inherited funds from the US to Belgium?
It's a loaded question because it depends on what nationality they are to which nationality they are.
Say from a US person to someone in Belgium. I don't know.
So yeah, it depends how they're reporting on what the assets are and where the assets are. So I would say that would be an offline type of question because it probably doesn't pertain to the bigger group. And I might misadvise them without getting all the details.
Gotcha. Actually, yeah, David, that would be something I would wonder about the Netherlands or Germany. I don't know if you had any thoughts on the inheritance tax in those particular countries.
It's a good question, and it's again client specific rather than speaking in generalities. There are so many permutations, and key issues are around is the estate taxed or is the recipient taxed or is there a potential double taxation situation because of things like US citizenship. So it's best addressed at an individual level.
Gotcha. Okay. Lots of ins and outs there.
Yeah.
Okay. Any other questions? So I don't have any other questions in the chat. All right. Well, then I think, is there anything else that we need to cover today? I don't think we have any other questions left for us to address from our end. Aside from if you have any holiday plans coming up soon.
Not yet.
Yeah. All right. Okay. Well, what I'd do then is I would say if you do have any questions after the webinar, then feel free to send it to us or to any of the panelists here. So we'll be sending out everybody's contact info afterward. And so aside from that, what I would say is just thank you very much, everybody, for attending our webinar. And always feel free to get in touch with us. Like I said, the respective details will be provided. And we'll be sending out a follow-up email with the recorded webinar. So should you wish to look over the material. And aside from that, we just hope you have a great rest of your day. Yeah, we'll catch up with you soon. Well, thank you, Brian. Thank you, David. It's always a pleasure. And yeah, have a great rest of your week. Hope you had a nice Easter weekend.
Thanks, Josh. Always good seeing you,
Thank
David.
you, Josh.
That's it.
Thanks, Brian.
All the best.
All right. Bye-bye.
Take care. Bye, everyone.